Okay, good morning again, everybody, and thank you for joining us for our webinar this morning that is designed specifically for bankers on the new CSRS 4200 standard and some tax updates. My name is Chris Picard, and I'm the Chief Business Development Officer with Bateman MacKay, and today I am joined by Alex and Vinay. So some quick housekeeping stuff. Microsoft Teams, if you haven't used it before, on the upper right-hand side of your screen, you should see the usual Teams options. So you can ask a question or raise your hand or live react. So I'm sure you were expecting lots of laugh reactions for this tax and accounting update, but the hearts, thumbs up, and claps are all well received as well. This morning, we are going to listen to Alex Doma, who's a principal with the firm, cover the CSRS 4200 update, and then Vinay, one of our tax partners, will provide some tax updates throughout this year. And with that, I will pass it on to Alex to get us started.
Thanks, Chris. Welcome, everyone. I think this might be one of our first ones and very well attended by strictly bankers and not any of our clients. So thank you for taking the time, first of all, to come out and listen to this fascinating new material. So as many of you guys know, you see them probably every day, compilation engagement, financial statements. So just to give a little bit of background, compilation engagement is essentially just assisting management in compiling financial information, right? So the last time the standard was changed, because it's a different standard, not 4200, was 1988. So for many reasons, many at the Institute and the banking associations wanted to push to move this standard forward to make sure that there's a little bit more similarities and standards when it comes to financial reporting via compilation engagement. So just so all of you guys are aware, and if you aren't, a compilation engagement as it stands right now, all that you have to do is receive the financial information. It needs to down add, and you can't be associated with fraudulent or misleading. So we basically ask, is there any fraud, right? To which everybody says no. That's it. There's nothing else you need to do. Now, many of you guys have received our financial statements, so you know in our discussions that what we do is a lot more than that, whether it's financial statement presentation, reconciling financial line items, asking pointed questions to our clients about the financial information, getting to know their business, all of which is not required, which is also why you see a massive disparity in the fees that your clients will be charged by various accounting firms, right? Because where we might be setting the bar here, a lot of accountants or bookkeepers can also are setting the bar here. So with the new CSRS 42 requirements, there are increased communication and documentation requirements for accountants. So the new 4200 standards need to be followed by CPAs when they're issuing financial statements that they know are for third-party use. This does not apply to bookkeeping arrangements, and this does not apply to what we might call T2 onlys, where you guys might have received the GIFI of the tax return. So you do not need to follow 4200 for those. And then this is effective for all notice to reader compilation engagements periods on or ending after December 14th, 2021. Hence the timing of this webinar. All December 31st year-end financial statements will be compiled under the new CSRS 4200.
Alex, so just to clarify, under existing standards, if I'm doing a notice to reader statement, not myself literally, but if an accountant is doing a notice to reader, do they technically even have to check whether the cash on the financial statements agrees to the bank statement?
No.
So
Right.
it could be anything.
Yes.
It could literally be whatever the client gives you. You take it, you put it on your letterhead. You don't ask a single question. You don't look at a single piece of backup documentation, and it's out the door.
Yes, that's it. As long as it adds up, right? And I'm sure many people on this call have also seen financial statements that don't even balance. So they're already wrong on that part.
So,
but Vinay, good question there. Guys, just to give a story, actually, I guess, one of our, a new client came in and noticed to read our financial statements, and there's no requirement right now, and there still isn't, to go back and review a prior accountant's working papers or anything of that sort like there is for audit engagements. New client came in, had a big tax bill, took a look at the financial statements, said, "You've got $1 million in cash, just pay it, right? You owe the tax, it's realistic." Client says, "Well, I don't know $1 million, what are you talking about?" Or sorry, "I don't have $1 million, what are you talking about?" Well, we pulled the financial statements, it's right here, it says, you have $1 million cash. What the previous accountant was doing was just plugging everything that was a debit into cash. So where he might have had $50,000 in cash, it looked like he was extremely liquid and had an additional $900,000 in cash. So perfect example, sad example, again, of just poor services being provided because the accountant clearly did not reconcile anything that was given to him to the bank statements.
right.
So one of the issues with compilation engagements is, again, to Vinay's point there, you can just do it however you want to do it. There's no standard per se, or there's no disclosure, I should say, on the financial statements. The difference now, they have added what's called the basis of accounting. So financial statements must include in their note 1 the basis of accounting which is applied. Now, Section 4200 did not specifically try to limit what needs to be done. It didn't say you have to use ASPE, or you have to use GAAP, or you have to use the cash basis of accounting. In saying that, the standard is open to somebody using ASPE as their financial statement guidance. I would hesitate if you ever saw that in a notice to reader set of financial statements, maybe unless it came from a larger CPA firm, because ASPE, as you may or may not know, is quite onerous, right? We would never prepare notice to reader financial statements in accordance with ASPE because you get into a lot different accounting treatments that are necessary. So I've put here on the slide, you can see this is the most likely, and this is generally how probably 90 to 95% of our notice to readers are prepared, maybe more. It's the basis of accounting to be applied, and the preparation of the financial information is on a historical cost basis, reflecting cash transactions with the addition of accounts payable and accrued liabilities. Meaning, if we know that there are expenses that applied, we ask the question. We say, hey, what else should we accrue? Accounts receivable less allowance for doubtful accounts. Same idea. We go through a quick question of, hey, we grab their accounts receivable subledger and say, looks like you've got a bunch of receivables over 90 days. Are these collectible, or should we set up an allowance for doubtful account? Inventory accounted for on a cost basis. That's generally what you'll see on financial statements. Rarely would you see anybody mark it up to, or we don't mark it up to market value. I'm sure some of you have seen that and somebody trying to get away with that. Albeit, again, 4200 does not restrict that, but it must be stated here in the basis of accounting. Income taxes payable at the reporting date, and then capital assets recorded at historical cost and amortized on a systematic basis. This is exactly what we do. So this brings me back to the beginning where I was saying you have practitioners who prepare very good notice to reader, compilation engagement, financial statements, and you have ones that do not. Now, all of these changes per se and basis of accounting, this is something that we already do. Now we will be required to disclose it on note 1 of the financial statements. So any financial statements that you see issued for year ends on or after December 14th, 2021, you will see this note 1 on there, right? And as part of the basis of accounting, it should be discussed with the management and or the third party. So this makes engagement, acceptance, and continuance a lot more important. Before, many practitioners might just take on a notice to reader engagement, not knowing what's going on. And this is why lots of times you'll notice that your clients are the ones sending you the financial statements, because previously, even though everybody knew the bank needed it, there was no guidance on what we're supposed to do. So we were issuing these to management for management, and if they chose to share it with a third party, that was within their right and they can share it, but it wasn't supposed to come from us. Now, as part of the engagement, acceptance, and or continuance of our clients, the practitioner shall make inquiries to management to ask what the basis of accounting is and what is the intended use and distribution of the compiled information, and if it's going to be used by a third party. If you cannot find these two pieces of information out, you cannot issue a set of financial statements under the new CSRS 4200 standard. Again, we do exactly this when we are discussing with clients on our engagement, acceptance, and continuance pre the standard being put into place. Asking who they are for, asking who's going to be using them. So now in terms of performing the engagement, again, to go back, all you had to do was take their QuickBooks, for instance, plug it into your financial statement information and send it away, make sure it balances. Now, the practitioner has to actually, for what I would say, do their job, or what they were hired for, or what the perception of what they were hired for, and actually understand the business and operations of their client, which of course is extremely important, as various industries have various knickknacks that you can better advise on and help clients with. You need to understand the entity's accounting systems and accounting records. And then, of course, as I alluded to, the accounting policies selected under the basis of accounting to be applied in the preparation of the financial information. So that note that I was saying, that must be there. We must discuss that previously. And the section doesn't, or the section acknowledges that owners or management may not know what this means, right? They know that we might have to handhold or sit with and discuss. And this all goes hand in hand with understanding the business, understanding the client, understanding their goals, what are they looking to achieve. But at the same time, the wool isn't pulled over your eyes as a banker as to how are they costing everything? How are they recording everything? Are these accounts receivable collectible? I know you guys do your own analysis and you obtain this information if necessary, but now at least it'll be upfront. It'll tell you if accounts receivable is netted with bad debts. It'll tell you if there were some accruals made. It'll tell you if it was just a cash basis of accounting. So it's a little bit more transparent, the financial information that's done, albeit, again, it is not perfect and rigid. There are different ways to present the financial information. So ultimately, what does this mean, right? Again, there will be better financial statements reporting to third parties, banks, lenders, management. It'll be more transparent. It'll be easier to understand. And clients will be more informed about their operations, because now it is mandated that we have these discussions with management. Before I go to the next two, these first 2 points and everything that we discussed before, and I know we've discussed this with many people on this call, nothing will change for us except for the fact that the report will be different and note 1 will be different. The amount of work that will go into this is already what we do. So for us as a firm, this is good news. The trouble is, as many of you on this call know is that there's such a wide range of financial information out there. Unfortunately, our institute has not really gone to bat for public accounting practitioners. Thus, anybody can issue financial statements, as you know, right? They don't need any CPA qualification. They don't need any qualification. They can issue financial statements, which is why you see such significant price disparity, quality disparity, people's sentiment on how they feel that their accountant is doing, the knowledge of their accountant. We here at Bateman MacKay obviously want to continue to increase the quality of financial information because this is what we do. We take pride in it and we issue good reports. I think we've heard from numerous, again, people on this call that when we see Bateman MacKay's financial statements, we get excited because we know that that they are good quality financial statements. We know that risk is good with the brand of, or the firm of Bateman MacKay, and that's fantastic for us to hear. We try to share that with clients, with prospective clients. Now, the tough part here going forward for the industry, let's call it, or CAs, CPAs, the next 2 points really is that there might be more work for some practitioners. Again, that won't affect us because we already do this work. The second one is what your clients might be running into is that if CPAs are actually following the standard, there might be higher pricing because ultimately there is more work. The one presentation we attended, the practitioner went as far as saying a possibly 20% increase in fees for all this additional work, additional working papers that must be done. I don't see that necessarily from our side because we have already set the bar for our quality there. We already have the information on our files of what our clients do, what systems and records they keep, and what the basis of accounting already is. Again, to refer back to that slide, that's the majority of them, right? To provide a more transparent basis of accounting for a majority of our clients. I don't think we really have any that stray from there, as that's the most appropriate basis of accounting. Now, before we get to questions, just one more comment. Banks were part of the reason for this big push of additional financial information, a little bit more transparency. Now, as I mentioned, the CPA brand and let's say the government has not legislated that CPAs are the only ones who can issue financial information, which creates a problem because if we come across an accountant who is not licensed, let's call it 123 bookkeeping, who is issuing statements for their client who the bank are using, then the advent of these new standards have really only increased our work and cost as licensed practitioners. We, of course, will rely heavily on the banks to institute policies in their lending agreements that ask for notice to reader financial statements prepared by CPAs or licensed CPA firm and prepared in accordance with CSRS 4200. So we look to you to do this. Otherwise, there is no recourse. We had just another story. We had I can't remember her title exactly, but a practitioner from the Institute come in we have an annual State of the Union to discuss financial reporting, ethical requirements, the reporting process if you come across poor financial information at all levels. And as a brand, as the Institute, we want to, of course, keep the bar very high. So the problem was, put up our hand and asked, said, what if we come across poor financial information from 123 Bookkeeping Inc., which we know was either fraudulent, they didn't do any work, they misled the client, etc. Nothing. There is nothing we can do. If it was a CPA firm who did that and lowered the bar for the quality, we can report them to the Institute. There is no recourse by the Institute to go after somebody who has no qualifications, right? So that will continue to perpetuate poor financial information. And I know everybody on this call here has looked at a very poor set of financial statements, and that's probably putting it nicely for some that you have looked at. So again, we ask the ask out there, and the reasons we're doing these kind of presentations is we look to you as the banks to mandate these standards, to mandate the quality of financial information that comes in, as I know that makes your job easier, knowing what you're getting is of a certain level of quality. So thank you for attending this morning, and if anyone has any questions, feel free. If there's anything I can't answer, we can take that offline, and I can follow up.
Alex, I'll ask a question and also make a comment. So speaking to the whole notion of the Institute being able to enforce its rules and regulations on unlicensed people, there's also some what I call pseudo licenses that I've seen out there in my experience. For example, RPA. I don't know what it's like, registered practice, registered public account. There's a number of them. There's some designations from other countries, even that may mirror. Like you could have a CPA from the US that uses CPA in Canada. You could have a CA from UK or anywhere else in the world. You know, that so they have the letters after their name. So how does a banker be able to distinguish who they're dealing with in those types of circumstances?
Yeah, good question. And just to go back, I don't want to say that all financial information prepared by people is terrible, but it seems to be that from people who are not licensed, that's where the worst financial statements are that we receive. And the Institute has a website where you can find either member firms or licensed practitioners, right? So you can search their name, you can search Vinay Costa's name, you can search my name, and you'll see if they're in good standing or if the firm is in good standing. So that's something that we just generally advise people to do. I saw somebody in the comments saying about family members issuing financial statements. I actually had a client earlier this year who said, yep, my stuff's filed, everything's great, but we're just, you know, we're growing, so we just want to move on. Well, their friend who was helping issue financial statements to do the tax returns, I got on the phone to say, hey, like, what's filed? Nothing's filed. Nothing. You have not done nothing. And he was, I think, an MBA student and just trying to make a couple bucks on the side to help out a friend, which ended up costing said client thousands of dollars because we had to go back to redo what was already done, which he already paid for. And of course, since things weren't filed 3-4 years ago, there's interest and penalties, which we tried to negate from some tax planning side. But again, we say it, and I know a lot of people on this call say it, is getting business owners to understand the value of surrounding yourself with professionals who know, right? Paying a good dollar to earn additional dollars or to take the headache away is invaluable. We've had numerous clients say just that to us, right? It saved my marriage because my wife's not doing the bookkeeping or my husband's not doing this, right? Thank you for those kind of referrals, or thank you for connecting me with these people who are holding my hand through this process, because you don't know what you don't know. And financial reporting is one of those big areas of you don't know what you don't know until somebody tells you, right? So lots of people, and I'm sure Vinay's heard it a ton, I have a great accountant, I barely pay any tax. And that's almost the trigger of, well, they're probably doing something wrong because you just rolled up here in a nice Mercedes and this and that, and I know how much money you might be spending. You probably should be paying some tax, but they never got assessed yet. And just Vinay will tell you is only a matter of time. And again, if their financial statements aren't very good, it takes us, it takes bankers, it takes other professionals to look at them and tell them.
So, Alex, previous to these new standards, notes to financial statements were were not supposed to happen. Like we weren't supposed to actually do notes to financial statements to notice to reader. I know some firms would be on client request, but now under the new standards, from what I understand, there is one note to financial statement. Will there be others?
So for sure, there is one note to the financial statements, and that's the basis of accounting. And that's what they deemed to be the most important note so that everybody understands what type of accounting is being done. Now, the standard has left it quite open to the basis of accounting. They did not want to make the standard too rigid, similar to ASPE, let's say, or IFRS. They wanted to leave it open, but disclosing and keeping it transparent. To Vinay's point there, notes were not a part of financial statements preparation. The reason being because once you start getting into that, you start blurring the line between a review engagement and a notice to reader, right? And to candidly speak, you start also increasing. You're opening yourself up to liability the more work you do, because all we were supposed to do is this, right? So if something happens and you've disclosed as such, you open yourself up that way. Now, in saying that, management can request notes. Management can request disclosures, right? So we have issued notice to readers with notes. The standard said no, but Section 4200 has left it open at the discretion of management and banks. So speak with management, speak with the accountants to continue to help increase transparency within the financial information.
So Alex, would you say, like, is the reason again notes, the Institute frowned upon notes to financial statements and notes to readers was for that very reason? The users, including most of the people on this call here, might construe that the accounting firm signed off on a review engagement. How do we distinguish now? Like, are the lines not getting very blurry? You've got a notice to reader, you've got note one, where to, you know, a more sophisticated user, but still not a CPA, reads note one. My view is that you guys pretty much audited this thing, you know.
Yeah, so in the report section of the financial statements, that's where you're going to see. So when you're looking at financial statements, to go back to our ask of bankers, is when you're looking at financial statements now that were issued December 31st or onward, as you guys do your reviews come April, May, June, ask these questions, right? If you did not see the report in the new engagement report, it still does qualify that this is a compilation engagement. It's prepared on records provided by management. But if the CPA knows what they're doing, they'll have identified in the report that these are being issued for the use of third parties. Okay, so that means that the person at least did ask the question, they understood the assignment, and then secondly, of course, note one will be there. But again, yes, the Institute frowned upon it because we did not want to start slipping from a notice to reader to a review engagement, and adding more and more notes starts making it look more and more like a review engagement. So again, this is increasing the standard, which is always good for us, just as it was good for us when the review engagement standards changed. We had an influx of clients come to us due to other firms either A, getting completely out of the business, or B, increasing their fees 30% in 1 year because they were never doing the best practices, right? And I don't think any of our clients even sniffed a fee increase at that point. We just continued chugging along because we had always been operating at the best practices.
It'll be interesting to see if there's any changes to the banking agreements that say, okay, we want notice to reader financial statements prepared in accordance with this reporting standard. And then if they take it to the next level, they may ask for specific notes.
Yep. So that's one question that we've been discussing.
Inclusive of disclosure on capital assets, maybe revenue recognition, maybe inventory valuation. So this is what I'm talking about. We'll see what comes from our financial institutions over time, but my sense is many of them have had enough of being misled by financial information, and they'll want more rather than less.
Yep. And this is something we've discussed internally. It will be interesting as the banking agreement to see if the banking agreements will be amended or new ones after, let's say, Jan 1, 2022 that are issued. Will they have the basis of accounting to be used by the practitioner? So these are all questions that we'll see, and of course we look to you guys out there to fill us in the direction that the banks are going. Does anyone else have any?
I'm going to actually mute myself, allow for the other good attendees in the room to ask questions.
Or add commentary, feel free.
Maybe we can move on to the tax side of things, and we'll cover any and all questions that come up at the end of the presentation.
Sounds good. Thank you everyone for listening. And again, even if you have no questions that you think of today, if something something arises, feel free. I know Chris had my contact information in there. Feel free to reach out directly. Thank you.
Good morning, everyone, and thank you for joining us. So this morning's presentation, I'll be addressing recent tax updates and as they affect many of your clients. And as bankers, when there's tax changes, we don't expect bankers to understand the nitty-gritty. But what's important for a really good banker business advisor, as many of you are, is to ascertain the implications of these tax changes to the forecasts of your clients. How will it impact cash flow? And also, very important is there's no surprises that appear out of nowhere. For example, a notice of reassessment. I'll try to address these tax changes that mostly come out of the federal budget, and as they can implicate the related implications on your clients. So most tax changes do arise out of the federal budget. There was no federal budget in 2020 for the first time in my career, my 20+ year career in taxation that I can remember. There was a skipped federal budget due to COVID. And in 2021, there was a budget tabled. And here are the highlights, which I'll address in a bit more detail as it arises. So in the federal budget, there's no changes to personal and corporate tax rates. There's an extension of existing COVID subsidies and the introduction of a new Canada Recovery Hiring Program, immediate expensing of capital property acquisitions, some mandatory reportable transactions disclosure rules, which could be very interesting for your larger clients, and something you need to at least understand at a high level as bankers. Limitations on interest deductibility, which is where on a go-forward basis, the banks can step in and assist clients in this regard for multinational operations predominantly. A luxury tax on automobiles, and a tax on unproductive use of Canadian housing by foreign non-resident owners. So from 2020 to present, there's been a plethora of tax changes and support programs. And we've published, for those of you who follow us on our website on LinkedIn, and otherwise. Is there a question, Nick? I see your hand up. In any case, for those of you who follow our website on LinkedIn, we have published in excess of 95 blogs concerning the changes in support measures and other COVID-related measures. So if you have any questions on the background of the specifics of any of these recovery programs, or need to refer back to these what the details of these recovery programs, I would encourage you to visit our website on LinkedIn or otherwise and take a look. So most of the emergency support measures expired as of October 23rd. So the SUS and those line items related to SUS, SIRS, and SERB that you see in the prior year, depending on the year end of your client, they're unlikely to continue in any material manner. So that will certainly impact the future cash flows. Chris, there's a request for Nick to be unmuted so he may ask a question. And I'll continue until that point in time. So the Canada Recovery Hiring Program, that's being extended until May 7th of 2022. And there's two new wage and rent subsidy programs introduced: the Tourism and Hospitality Recovery Program and the Hardest Hit Business Recovery Program. And I think actually the intent of those new programs is self-explanatory in the title of those recovery programs. Next slide, please. Yeah, so the Canada Recovery Hiring Program, that was introduced in the 2021 federal budget, and the intent is to assist businesses with reopening, such as staff wages, increased staff hours, and hiring of new staff. So there's 4-week defined periods beginning June 6th of 2021 through to November 20th, 2021. And the subsidy is based on the excess remuneration when you compare it to the same period in the prior year. It does require a revenue drop, which is calculated similarly to SUS and SIRS. And the maximum subsidy rate of 50% is gradually decreasing to 20% by the end of the program. It's quite a complicated table, and we've published a table in that regard. I'm just gonna, Nick, do you mind putting your question in the chat box? I didn't realize you're unable to be unmuted.
Yeah, I'll do that, no problem. I'll put it in the chat box now, okay? Thanks.
I can hear you now, Nick.
Oh, I thought you wanted me to go through the proper procedures.
No,
all right, I'll make this quick and short and sweet then. Thanks, Alex and Vinay for this presentation. And going back to the last slide on all the government subsidies, I know it's been about 20 months right now, so we're starting to see more and more sets of financials come across our desk for many of our clients. And there's a lot of inconsistency on the P&L in terms of where accountants plug certain subsidies. So is there a standard that we need to kind of look for? I'll give an example. I've seen wage subsidies fall under the revenue item. I've seen it fall under after the net income section as well. So I've seen that kind of placed in many different areas of the balance or the income statement, as well as the rent subsidies. So what's the consistency that we need to kind of look for?
I can speak to that. Thanks, Nick, for the question. There is no current standard per se on where it should be. We've seen it, like you said, in revenue. We've seen it netted against salaries and wages. As a firm, internally, we looked at who the users are of the financial statements. where would it be that it makes the most sense? The consensus was to put it beneath the line, which would be in other income section. The thought process behind that was it's there in plain sight for when we meet with clients to say, hey, look, you actually weren't profitable, or you were profitable before you received any government funding. Thus, we thought it was best for management and owners, frankly, to realize how their business is doing without the money. And many bankers have commented or been thankful for us breaking it out in that section, so that they didn't have to go chasing the client for how much did you receive, because you can see it afterwards. Because as you said, these programs are waning down, and frankly, they won't last forever. Thus, we want to see how the business can stand up by itself without this money. So as a firm, we have it in the other income section for those reasons. But again, there's no consistent standard. Some people like to hide it in other places. We like to be as transparent with our users, whether it's management, owners, or banks, which makes everybody's life easier. Good question.
Thanks,
Thank you.
Alex. And
Great
yeah, that wasn't directed at Bateman MacKay, because I've seen many of your financials and they're wonderful. You guys are great on full disclosure. So I guess the key takeaway for us there is just to make sure that if it's hidden, we need to ask the appropriate questions and adjust it from a year-over-year comparison basis when we're doing our due diligence. Okay, thanks so much, guys.
Great
Appreciate
point.
that.
Absolutely. And just to add to that, I know we're not talking about review engagements, but I know a lot of you see that. Review engagements aren't set up like that. It is part of the government assistance, and it may be netted with salaries due to the standards. However, any government assistance that is received through the year has to be disclosed in the financial statement. So if it's not on the face of the P&L, it will be and is disclosed, at least in our notes, in the government assistance section. So just keep an eye out for that as well when you're looking at review engagements.
We're going to power through. We're running short on time. Next slide, please. So this is actually a fairly significant tax measure introduced in the last federal budget, aimed at encouraging capital investment by clients. So it allows for the expensing of up to $1.5 million per taxation year on eligible property acquired by a Canadian-controlled private corporation after April 18, 2021, provided it becomes available for use prior to 2024. So that's significant. It is a limit, and it has to be shared amongst associated corporations. So think of it from a client cash flow perspective. So let's say you lend a client $1 million to acquire a piece of capital assets. And let's say it's a profitable client. So that $1 million under, let's say, the old regime, and let's say it's standard manufacturing and processing equipment, might be eligible for, call it a 30% capital cost allowance rate, 15% perhaps in the first year with the half-year rule, saves the client about $150,000 times 26% of tax. So we're talking about ballpark $30,000-$40,000 in tax savings associated with your loan. Now, it could save, let's say again, it's a highly profitable client. You lend the client $1 million. It could save the client upwards of $260,000 in the year of acquisition. And especially if you do, let's say it's a December year end, this would be an ideal time for this type of financing and this type of capital investment if they're otherwise going to make that kind of investment. That's what the budget said. Now, in the history of tax, the budget as tax accountants, we're allowed to file based on budgeted announcements. So there's a federal budget, there's legislation, it's in draft legislation, but we're allowed to file based on what was announced. And that's completely acceptable. However, in select cases, for whatever reason, CRAs disallowed that expensing, saying the budget has not passed into law. So I think it's just a question of CRA playing games with our clients. Not too many of our clients. Some have gone through, others have not. It's very inconsistent. But it's a big caveat to clients that perhaps we need to wait this out, let the bill pass into law, and then file an amended tax return to obtain that tax refund. So perhaps again, a creative banker could get into financing that anticipated deferred tax asset. Next slide, please. Reduced tax rates were introduced for zero emission technology manufacturers. We'll go to the next slide. Interest deductibility limits. So these rules apply where, let's say you have a company in another tax jurisdiction, US, Europe, or whatever, that's financing the Canadian arm. Well, in those kind of circumstances, there's a restriction on the interest deductions. Your bank debt, on the other hand, there's no such restrictions on interest deductions. So if I was the owner of a multinational corporation, everything else equal, I would use foreign affiliate money to finance to the extent I'm allowed to utilize my interest deductions, and then I'd be looking at my banker to replace that affiliated debt. And yes, Michelle, these slides will be shared. Next slide, please. So there's new mandatory disclosure rules on what I call aggressive tax planning, and whereby if a certain set of transactions falls into what could be viewed as an uncertain tax treatment with potential reassessment implications, tax advisors have to disclose that to the Canada Revenue Agency. Next slide, please. I now go into what represents a reportable transaction if it meets the hallmarks of an avoidance transaction. Next slide, please. And I continue with what's a note. If it's reportable, under what circumstances do you have to notify CRA? And there are penalties for taxpayers who do not report their notifiable transactions. Next slide, please. Now, for larger corporations, there may be financial disclosure requirements with respect to uncertain tax treatments. So this is where there's a bit of an overlap between tax and accounting. So sometimes the disclosure we have to do for tax purposes may fall into the financial statements of a larger client. So if the corporation has at least 50 million in assets at the end of the year, and they have audited financial statements that are in accordance with IFRS, there may be a note to that client's financial statements reflecting an uncertain tax position. And if any of you ever see that note, you need to delve deeper with the client's accounting firm and what's going on and assess the probability of reassessment. Next slide, please. And then there's a quantum of tax, so that should also be ascertained in that note to financial statement. Next slide. We'll go on the new disclosure. If there's this kind of disclosure made, the period to reassess is extended until the time the disclosure is made. For any of you that finance auto dealers that may sell luxury cars, you should be assessing with your client the implications of this new luxury tax effective January 1st, 2022, and what's the implication on their on the demand for their cars. The new housing rebate, for those of you doing any personal lending, there's been changes there. So currently, when a home is purchased or built by two or more persons, all purchasers must use the property as their primary residence in order to qualify for the HST housing rebate. Now, the proposed changes are that if the home, you can qualify if it's just built as a primary residence for one of the purchasers. Next slide. If you're financing the acquisition of Canadian housing by a foreign non-resident, you should be aware, and they should be aware, of the 1% tax on the value of the non-resident, non-Canadian owned residential real estate that may be considered vacant or underused. And there's an annual declaration for that measure. Now, I guess in the 17 to 19 federal budgets, CRA has consistently received additional funding over and above their regular budgeted amount to assist them with enforcement, with their verification and enforcement activities, offshore examinations, and other type of audit work. And that continued in this budget. So we see, and we are seeing, an increase in CRA activity. They were largely silent during the peak of COVID. I'd suggest from March of 2020 till end of September of 2020. They were quite silent. Now they're kind of waking up again, and they have more money. In my discussions with senior CRA officials, they're hiring like no tomorrow, and it should be an interesting landscape for our clients. In that respect, our clients, we offer our clients a product called Audit Shield, which we just offer as a service. We don't, we basically collect their money and we submit it to Aon as the insurer. And in the event that they're audited, their professional fees to deal with the audit is reimbursed up to a certain limit of either $10,000 or $25,000, inclusive of as needed tax lawyers. So that's our response to increased CRA activity as a value-added service, so clients can focus on their business and not as concerned with CRA audit measures. Any questions? Well, somehow made up the time and we're 5 minutes sooner. So if any of you happen to have any questions for either Alex or myself, all of our contact information is below. Chris will be circulating our slide deck to all of you, and never hesitate to reach out.